So what does it mean must remain in balance? As you recall, when we did transaction analysis, we talked about how when assets increase, there must either be a decrease in an asset or an increase in a liability or an equity. So let's take a step back and we're going to talk about what is a T account, and we're going to talk about how journal entries are recorded and how it affects T accounts. So let's clear the page and we're going to do this together. So, assets must always equal liabilities and equity. This here is our friend, the T account. And every single account that a company has a general control T account that records all of those entries. For example, one asset we have is cash. There is a T account for cash and it records every single entry. Every liability, every asset, every equity account has their own T account. Now, this is the basis of double entry bookkeeping, that what happens on one side must be matched by an opposite entry on the other side. So what do I mean by this? Asset accounts increase on a debit. If you recall, debit means left. So when cash goes up, we increase it on the left side of the T account. When cash goes down, it is decreased, and that means there is an entry on the right side. Now, liabilities and equities work in the opposite way. So when an equity or liability account is increased, it is increased on the right side. And when it decreases on the left side. So this way, at all times, the left side and the right side will always be in balance. If this isn't clear yet, don't worry, it will make sense. So I'm going to clear the page again, and we're going to try practicing a couple of journal entries, and we're going to show how it would look in a T account. So let's start off. We're going to just do some basic entries. So let's say we have a T account for cash, and we have one for contributed capital. Now, cash is an asset account, and contributed capital is a shareholder's equity account. So if you recall, assets increase on a debit on the left side and decrease on a credit. Contributed capital increases on a credit, the right side, and decrease on a debit, the left side. So if we were to write a journal entry, the first thing we do is we write the date. So let's say today was January 1st, and we received cash from an initial investment from a shareholder. So we then write the name of the account. So cash is debited on the left side. In exchange for the cash we received, we then had a credit. So you start off the journal entry, date, and then you start listing all the debited accounts. Debit does not always mean increase. Remember, it just means on the left side. We then write the accounts that are credited normally with an indentation. So contributed capital. So we can look at this and say, okay, cash, an asset account, was debited. So when an asset is debited, it is an increase. So an increase to assets. Contributed capital is an equity, and that was credited. So that is an increase to shareholders' equity. So let's say $5,000 was given for shares. So this is your very first journal entry. So let's record it in the T accounts. So we have over here our cash T account. What happened to cash? Well, we debited the cash account. So we're going to put $5,000 on the left side of the T account. So if you look at the T account, 5,000 on the left side of an asset means there is 5,000 in the account. Now we're going to look at contributed capital and what happened. If you look over here, we credited contributed capital for 5,000. So we mark on the right side of the T account. If you look here, it matches. So any account that is debited is therefore if an asset increased. I hope this makes sense. If it doesn't, feel free to pause, go back, and watch this section again. Now let's try something with some liabilities, and we're going to play with more than 2 accounts this time. Let's say the next day, January 2nd, the company decides to purchase some inventory. So inventory is an asset, and if inventory is going to increase, we debit it. So debit inventory. Let's create a T account for inventory. We paid for this inventory by cash, so we credit cash because we decreased the asset. But remember, more than 2 accounts can be affected at the same time. So we also got some of the inventory on credit. Our supplier gave it to us with the promise to pay later. So we're going to credit trades payable. You just write TP for that. And we're going to create an account for that. So trades payable. Remember, payable means liability, and inventory is an asset. So we decided to purchase $10,000 of inventory. We did not have enough cash for that on hand. So we then credit cash by $5,000, whatever we had left to pay. And we also got some on account. So this is an increase in liabilities. We increased our debt for $5,000. So let's now mark this in our T accounts. So first, we debit inventory. So on the left side, we write 10,000. Cash, well, if you look, we decreased our cash by 5,000. So let's put this on our T account. So cash went down by 5,000. We then had to get some of the inventory on account. And remember, this is a liability. So even though we are crediting the account, it is an increase to the liability. So 5,000 over here. And at the end of the period, what you can do is you would just put at the very bottom of the line, and you would add everything up in each account and see what the ending balance is. So for cash, we had an increase of 5,000, but also a decrease of 5,000. So plus 5,000 minus 5,000 gives us an ending balance of 0 in cash. We have $5,000 ending balance in our shareholders' equity. Our trades payable had an ending balance of 5,000, and we had 10,000 inventory ending. So what I'd like you to please do is pause for a moment and just add up. How many assets does the company have? How many liabilities does the company have? And how much equity does the company have? And is the equation in balance? So let's take a look at it together. Assets, well, we have $10,000 of inventory. Liabilities, we have $5,000 of trades payable, and we have shareholders' equity and contributed capital of $5,000. So actually, it is in balance. The $10,000 of assets is funded by $5,000 of debt and $5,000 of shareholder investment. So what we're now going to do is we're going to flip to the next page, and we're going to practice some journal entries together. Just something I wanted to note, which may help this be more simple for you, is sometimes when you're doing a journal entry, begin by writing DR, and then you can write, for example, cash, and then credit, let's say, bank loan. And the DR here means debit, and the CR means credit. And you don't need to do this on your exam, you don't need to do this during journal entries, but it could be helpful for you to just put the DR and CR before while you're practicing to help you get used to the journal entries and the system. And what you can then do on your T account, so let's say we have our cash T account here, we would then write DR for the amount, and for our bank loan, we can then write CR and then have the dollar amount there. So I don't know if that makes it more helpful for you, but I definitely do this when practicing, and this is how I learned to do it. So hopefully that can be helpful for you too. So what we're going to do is we're going to clear the page, and we are going to practice doing journal entries together. and I'd like to ask you to try them out and then see if we got the same solution that I did. So let's practice doing these journal entries together. I'm going to tell you what happens in the transaction, and you try to write out the journal entry. I also recommend that you make some T accounts on the side and keep track of what's going on. So the first thing that happens in our story here is you decide to invest $5,000 to start your own company. So why don't you try practicing the journal entry for that? So remember, this is from the company's perspective. This is not from your personal perspective. So January 1st, the company received cash. So it is a debit to cash. That is an increase of assets of $5,000. And what did the company give up to you in exchange for that? Remember, this is all from the company's perspective. So the company credits contributed capital, and this is an increase in shareholders' equity of $5,000. They gave you $5,000 of shares for it. So let's put this in our T accounts. We have our cash T account, and we have our shareholders' equity T account. So the $5,000 here is going to be recorded over here, $5,000. And the $5,000 of equity given up, the $5,000 of shares given, is going to be recorded on the right side. Remember, it is a credit. So we'll just put a CR here. This is a credit, and this is a debit. So I hope you got that right. Let's go to the next part of our story. Your company decides that they are going to purchase a truck for $30,000, but you don't have the cash to pay for it now, right? You only have $5,000. So you buy the truck in exchange for a note payable. So you buy a $30,000 truck in exchange for a note payable. Why don't you try that out? So we debit truck, and this is an increase in assets, and it was purchased for $30,000, but it was not paid for in cash. Instead, we are going to credit note payable. And remember, payable is a red flag that it is a liability. So we credit this for $30,000. So let's create some T accounts for it. So we have our truck account here, and we debit it for $30,000. And we have our note payable. And remember, note payable is a liability, and we credit this for $30,000. So the company currently has, if you add up the cash and the truck, we have $35,000 of assets, and this is funded by $5,000 of equity and $30,000 of debt. Let's go to the next part of our story. So you decide that you want to pay off this note payable ASAP. So what you do is you get a bank loan for $45,000. So let's record the journal entry to record this. So we debit cash because the company received cash for the bank loan. So $45,000 of cash was received. And we got this in exchange for a bank loan. So the liability increases. It is a credit. So an increase to liabilities of $45,000. So the $45,000 here of cash is going to go up to our cash T account. So we debit $45,000. And we are now going to create an account for our bank loan. So the $45,000 bank loan is going to go here. We credit $45,000, and this is a liability. Just like the payable, we owe this money. So now that the company has $50,000 cash, right? $5,000 from the initial investment and $45,000 from the bank loan, let's go ahead and record a journal entry to pay off this note payable completely. So why don't you try that out? So what we do is we now decrease the liability, right? We have our note payable of $30,000 that we want to get rid of. So we increased it by crediting it. We are now going to debit this note payable. And this is a decrease to liabilities of $30,000. And we pay it off by crediting cash. So we have to give up cash of $30,000 to pay off the loan, the note payable. So let's record this in our T accounts. We'll start off by decreasing the note payable. So we debit by $30,000. And if you see here, these two cancel each other out. And now the $30,000 that we decreased in cash, we are now going to credit from our cash T account. So what we can now do is just take the totals of our accounts. So why don't you take a minute and try just getting the ending balance of each account here. So 5,000 plus 45 gives us 50 minus 30,000. We have an ending debit balance of 20,000 cash. And since cash is an asset, we have 20,000 cash. We have $5,000 of shareholders' equity. We have $30,000 in our truck. We have nothing in our note payable account, right, because we paid it all off. And we have a $45,000 bank loan. So why don't you just take a minute and try and figure out the structure of the company. How are we financed, and how many assets, liabilities, and equities do we have? So assets, we have 50,000, right? We have the 20,000 cash and the 30,000 truck. We have $45,000 of liabilities from our bank loan, and we have $5,000 of equity from our initial investment. I hope this is clear to you, and if you're confused, you can always rewatch it. So let's take a step to the next part of our presentation today. Let's look at ratios. So for this chapter, you're lucky, you only have one ratio to learn for chapter 2, and that is the current ratio. So the current ratio is equal to current assets over current liabilities. And what this teaches us is how many dollars of current assets do we have to pay off every dollar of current liabilities. So if we had $100,000 of current assets and $50,000 of current liabilities, we would have a current ratio of 2. And this means for every $1 of current liabilities, we have $2 of current assets, meaning that presumably the company is in a position to pay off their short-term debts. So this is what we call a liquidity ratio, because it measures the short-term ability to pay off debts of the company. Now, the current ratio is not perfect, and it can be misleading. If the company does not have any cash and they have a lot of inventory, it may give the impression of being highly liquid, while they may not actually be able to pay off their debts immediately. We're not going to go too into depth about the ratio, and I highly recommend you look into your textbook and read up more about this ratio. And now we are going to get to the final part of today's lecture, Java Joe. So Java Joe is going to be a series of examples that are going to build through every single online lecture that we do together. And we are going to follow it, and it's going to help you to apply everything that you've learned. So let's take a look at our scenario. Joe Cuppa is a recent graduate of JMSB who loves drinking coffee like any student. And since he loves drinking a cup of Joe, he has decided to start a coffee shop in Montreal on Bishop Street. So he has come to us to ask us to help him with the accounting for his business. So since we're nice people and he's offered to, pay us a little, we're going to help him out with the accounting. Why not? So let's get into this example together. Now, I highly recommend in this section that you pause and you try and work out the journal entries on your own. You try to put everything into the T account on your own. And at the end, we're going to actually build a statement of financial position for Joe. So I really recommend that you try this out and then check your answers with what the correct solution is. So we're going to do this step by step. So entry 1 on January 1st. Joe decides to invest $5,000 in the company. So why don't you take a minute and try to record this on your own. So the first thing we do, so January 1st, let's say it's the beginning of the year, we debit cash. So let's make this a little prettier for you guys. We debit cash. Now cash is an asset account, so it's an increase in assets of $5,000. So the company got $5,000 in exchange for giving up some common shares. So we credit contributed capital. So that is an increase in shareholders' equity of $5,000. Now Joe realizes that $5,000 is not enough to start a company. So he goes to his friend Jill and he asks Jill to invest $25,000. So let's record the investment by Jill. So this is going to be on January 3rd. The company receives more cash, so it is an increase to assets of $25,000. And remember, this is an investment. Jill is also going to be an owner of the company. So we credit contributed capital, and it is also an increase to shareholders' equity of $25,000. So let's see what this would look like on our T accounts. So we have our cash T account, and we added $5,000 from the first entry and $25,000 from the second entry. We also have our shareholders' equity. So why don't you try writing this out in your T account? Remember, it is a credit of $5,000 and a credit of $25,000. So let's take a look back at our entries. The next thing that happens is they decide to seek additional funding, and they get a bank loan of $20,000. So why don't you try to write this out? January 5th, they received a bank loan of $20,000. So January 5th, cash increases. So that is an increase to assets of $20,000. And we credit bank loan. And what type of account is bank loan? It is a liability. So that increases by $20,000. So let's put this on our T accounts. So we debit cash $20,000, and we create another T account for our bank loan. All right, January 6th, Joe decides to prepay rent for the year. So January 6th, he is going to pay rent for the entire year of $12,000. Now, we are paying in advance, so this is actually an asset. So let's work this out together. Prepaid rent is going to increase, and that is an asset. In exchange for this, we gave up cash. So that is a decrease to assets. So $12,000. And we're going to record this right away. So $12,000 decrease to cash. It was a credit. And we have our prepaid rent that is going to go up. So we debit the asset, and it goes up. Entry 5. Java Joe decides to invest and purchase some inventory. So they buy $10,000 of inventory, half on account and half through cash. So let's repeat that again. Java Joe buys $10,000 of inventory, half on account, half by cash. So we know that we received inventory. So we debit inventory, an increase to our assets of $10,000. And half was paid by cash. So we credit cash, that is a decrease to assets. And we're also going to credit trades payable. Remember, it was half on account, so half through credit. Excuse me, that is not an asset. It is an increase to liabilities. So half by cash, so 5,000 cash, and 5,000 trade payables. So let's record this. So inventory is 10,000. We credit cash by 5,000. And we also are going to credit our trades payable by 5,000. Finally, 6. We decide to hire employees to work in the store. They have not begun to work yet. So what is the journal entry yet if we're going to pay them $10,000 a year? So this is actually a trick question. There is no entry if they have not started to work yet. We will only record an entry if we've actually paid them or if they've started to work. And we're going to cover this further in the next lesson when we cover the accrual and cash basis of accounting. But what you need to know is that if they haven't started working, we haven't paid them yet, there is no entry. So with these accounts, what I'd like you to please do is figure out what is the ending balance of each account. So take a minute and figure that out. So we're going to start with cash. So when we add up all the debits on the account and we subtract all the credits, we end up with an ending balance of $33,000 of cash. Our prepaid rent is an ending balance of $12,000 on the debit side. And our ending inventory is a debit of $10,000. Let's look at our equity and liability accounts. So our ending shareholders' equity, contributed capital, is $30,000. Our ending bank loan is $20,000, and our ending trades payable is $5,000. So what I'm going to ask you guys to do is take a minute and try and write out the balance sheet for Java Joe. And we're going to do this together. And this is going to be the balance sheet as at January 31st at the end of the month. So we're going to do this together. We're going to solve it together. So let's clear off the left side here, and we're going to keep our T accounts because they're going to be very helpful in building the balance sheet. So if you recall, the first thing we always do with any financial statement is we start with the title, beginning with the company name. So Java Joe Inc. And this is the statement of financial position. And this is as at, if you recall, the balance sheet is one specific point in time. So as at January 31st, 2017. And all figures are in Canadian dollars. So the first thing we're going to do is we're going to start listing off the assets of the company. So we begin the asset section. And we begin with our current assets. And if you recall, it has to be in order of liquidity. So let's look at what assets we have, and we'll discuss which is the most liquid. So let's discuss which is the most liquid. the number one most liquid asset is going to be cash. Now, between prepaid rent and inventory, what do you think is next? Well, the answer is inventory. Inventory is going to be second of our assets in liquidity. And finally, our prepaid rent. So let's put these on our balance sheet. So we begin with cash, and we then write the amount that we have. So we have $33,000 of cash. So $33,000. Then our next most liquid asset is our inventory. So inventory, $10,000. And then we have our prepaid rent. And we have $12,000 of prepaid rent. So we are now going to add and get our total current assets. So we add these guys up. So we have $55,000 of total current assets. Do we have any non-current assets? No. So our total assets is $55,000. We can now clear out these T accounts over here to make room for the rest of our balance sheet. So we will begin with our liabilities. What does the company owe? So let's take a look. We have a bank loan, right? That is a liability. And we have a trades payable. So let's talk about which of these is the most liquid and which is current and non-current. So typically, trades payable are the most liquid of our current liabilities. So that would go first in our current liabilities section. So we have our trades payable of $5,000. And that is our total current liabilities of $5,000. Now we are going to add up our non-current liabilities. Now typically bank loans are given for a few years. It could be 1 year, 5 years, 10 years. We don't know exactly how long the bank loan is, but we can safely assume that the bank loan is a non-current liability. So bank loan for $20,000. So we're going to add the $5,000 and the $20,000, and that will give us our total liabilities of $25,000. So just to reiterate what we said about the bank loan. So we're going to assume, right, that this is a non-current liability, but it could be that the bank loan would be due sooner. If we had a bank loan that was due in less than a year, we would actually put the bank loan in our current liabilities. But because we can assume, let's assume that this is a 5-year bank loan, we are going to keep it in our non-current liabilities. But just remember, it's important to pay attention to when it is due. And now we have our shareholders' equity section. So we have our contributed capital. So let's look, and this should actually say contributed capital. So our ending balance in this account was $30,000. Does the company have any retained earnings? Not yet, because they haven't made any sales yet. So our total equity is $30,000. And we now add up total liabilities and shareholders' equity. So to do that, we add our liabilities and we add our equity, and that gives us a balance of $55,000. So let's zoom out and take a look. Our assets of $55,000 equal our liabilities and our equity. So the $55,000 here and the $55,000 here match up. So our balance sheet, our statement of financial position, balances. And this is ideally what you want. If it doesn't balance, you made a mistake somewhere. So If you got a chance to try this problem and you got it right, congratulations. If you made a mistake, try it out, figure it out again, and if you watched through this and you got an idea, why don't you take a step back, try out the problem, and see how comfortable you are with the material. Thank you so much for listening, and we hope to see you in the next lecture.